Thanks, Andrew.
All right, our next speaker is well known to everybody, John Ciampaglia, who's the Chief Executive Officer of Sprott Asset Management, and he's the portfolio manager for all the physical trusts, the gold, silver, and of course, importantly, the uranium trust, the Sprott Physical Uranium Trust, which really set alight in the market, two or so years ago when. John was certainly ahead of the curve in recognising that this industry was heading into shortages and set up the SPUT vehicle to take advantage of that. And has for those investors who got involved early in that vehicle have made a super return. It's gone a little bit quiet this year, John, with that pullback in equity prices, and I guess the SPUT vehicle itself trading below net asset value, which has sort of limited your ability to raise capital and make new purchases. But I do note you're pretty well back at NAV, I think, overnight with the rally that we've seen. So it looks like the next wave of activity may be just around the corner. So, look, John, your insights on the industry itself, on what's happening, are always really insightful and useful. And an update on the SPUT vehicle would also be appreciated. So, over to you.
Yeah, thanks, Andrew, and thanks everybody for participating. It was a great overview that Treva provided. It's a really great backdrop, and the fundamentals are just incredible, and they continue to get better. But the one thing about uranium that I often remind people about is it's a very unique commodity. It does not behave the same way as other commodities, and so many things in the nuclear fuel industry and the fuel chain move at kind of glacial pace, and it sometimes looks like not much is happening, but I assure you there's lots of things going on underneath the surface. But as you mentioned, Andrew, it has been kind of an odd period. I would describe it as two parts confusion, one part frustration, talking to investors from around the world, which we do very regularly. And the confusion was really, I would say, coming from a number of things, everything from sanctions, the waiver process, Kazakhstan production, what's the real number? It was changing every few months. Could there be retaliatory sanctions by Russia, for example? And the frustrating part is because, in the short term, some of these macro noise drivers can really crowd out the long-term fundamentals, and that's the part that people find frustrating. But our belief has been that the long-term drivers will ultimately, drive prices higher, and that's been our thesis for the past 4 years, and I think it's played out. So I am gonna share my screen. It was helpful to hear what Treva said, so I don't duplicate what she says. So here we go. Let's see. Hopefully you guys see that okay. So let's talk a little bit about the trust. The timing for this virtual conference couldn't be better, because in the last 2 days we've raised $10 million of new capital, which is the first capital raises we've been able to do since May 21st. That's a very long dry spell, and that is not uncharacteristic of the typical seasonal slowdown that we see in the uranium sector in the summertime. It's happened the last 3 summers. This year was a lot of sitting on hands waiting for the Kazakhs to tell us on August 23 what their production was going to be. The summer before, there was definitely a lull in the market that represented a low in sentiment. And sure enough, September came along, and WNA and some production problems at Cameco, and those were the sparks we needed to get the sector going again. In the summer before that, it was a quiet period in the market, and the Japanese announced at the end of August that they were going to restart more reactors, and that was the spark we needed to kind of get things going. I find this market is very catalyst and news driven, and so there are periods where there's very little information flow. It is an opaque business, and so everyone is waiting patiently for some of the incumbent producers to give us guidance on what's going on. And we do our best to try to connect the dots for investors. So let's just get right into it. There's our disclaimer. So just talking a little bit about what's been going on this year. Everyone knows that we've hit an air pocket in the spot market. We hit $106 after starting the beginning of the year at 91. We've corrected down to about 79.50, and today we were up a bit at $81. So a healthy correction. I think it's fair to say it was probably expected, and as Treva mentioned, the spot price really became decoupled from the term price. The good news is you look at the term price, which doesn't come out as frequently, It goes up every month. It goes up by small increments, but it's clearly going up. Overall, as Treva said, market activity has been really quiet. Now, whether that's intentional or not, it's hard to know, because one of the things that one of the characteristics about the uranium market, it's very voluntary, meaning participants can volunteer transactions either in the spot or term markets to the pricing reporters, or they may choose not to. And so we obviously hope that participants provide information so that we can have the best available market signals. We report all of our transactions to different organizations so that people understand what we're doing. But I think it's fair to say that, there are some theories around why maybe the market activity's been light. Maybe the utilities are still adjusting to a very different pricing environment. Where we were last year, we still had the spot price around $60 a pound, and we had term pricing with a collar around $50 to $80. Now we're hearing, perhaps that collar is 75 or 80, going up to 130. That's a big material difference in terms of, the new pricing environment that utilities are having to get adjusted to, particularly for their capital and budgeting process. As I mentioned earlier, the ban that the US has finally implemented as of August was kind of a long, drawn-out affair. We do have some clarity on the waiver process. And then as of September 11th, Putin is clearly saber rattling and saying his government is going to review whether they should restrict key exports, including uranium. So, to be determined. As I mentioned, Kazakhstan, all eyes were on them, given the ebbing and flowing and their messaging over the last 12 months around increasing production, cutting back production, sulfuric acid shortages, et cetera, et cetera. I think the main takeaway that we have is that they are either unwilling and or unable to materially increase production, which is very important. We think that's very important in terms of the longevity of this bull market. And the other key takeaway is that their cost structure is going up, as well as taxes in the country around the mineral extraction. Tax is going to be going up next year, which is also going to push out the global cost curve for uranium. U.S. Department of Energy, there are 2.7 billion tenders out there. This is really about reshoring the nuclear fuel supply chain away from parties like Russia and building on local soil. We've obviously just had a very positive announcement from Orano in terms of building a brand new enrichment facility in Tennessee. Urenco has announced a number of plant expansions around the world. This is all about the transition away from Russia, and it's going to take anywhere from 2 to 5 years. Definitely some uncertainty with the presidential election. It's interesting that when Trump debated Biden, and the next day uranium and renewable stocks all sold off, and I thought, isn't that odd? People somehow think the Republicans, if he wins, are going to be against nuclear power. Nothing is further from the truth. That was a short-term distraction. We think both parties will continue to be very supportive, given all the bipartisan support of all the numerous bills that have been passed the last 3 years. So as I mentioned, the summer period is typically an air pocket period. It feels as though we've moved through it. There have been a number of positive catalysts in the last few weeks that is getting the market, I think, back in better position. And Treva mentioned some of those. So let's just talk a little bit about the spot market. So this is where obviously we play in the uranium market. This is the much smaller of the two markets. But just to give you some perspective, it's been a very quiet market year to date. Now, what are the reasons for that? Well, I think it's very clear. We haven't bought as much uranium. We've bought about 2.5 million pounds this year. Second of all, producers have been less active in the spot market. I think it's pretty simple math. Why would you be buying uranium at $80 or $90 to deliver against the contract book that you might be getting $60? That doesn't make any sense anymore. So inventories are being drawn down. And then finally, utilities historically would buy 5 to 15% of their uranium in the spot market. They've kind of walked away from the market as the price, broke through $90 and $100. So I think all those factors have led to a slowdown in the spot market. But let's shift to the term market, because it's obviously the much more important. And I thought Treva made a really interesting point about utilities are being more cautious about signaling contracting. So this information comes from UX Consulting, and it basically shows you the utility long-term contracting volumes. Treva mentioned that last year we hit 160 million plus pounds, and the industry kind of celebrated that we were back to replacement rate contracting, this theoretical level of around 150 odd million that gets reported. I put that red line there to mark that. But what's interesting to us is if you take out the one-time purchase by the Ukrainians, that was 40 million pounds out of the 160. So our position is based on reported volumes, we're not there. Fast forward to 2024, those two little blue lines at the bottom. So far, what's been reported is 44 million pounds for the first 8 months of the year. So we are way off of annualized replacement rate contracting, whether this is pricing, whether this is contract negotiations are dragging out, whether this was the Russian ban and the waiver process distracting. It could be all of those things. It's hard to know, but I think it's fair to say that reported contracting volumes are light. From what we are hearing in the market, utilities are back from summer holidays and are starting to put RFPs out in the market, and we would expect this to pick up in due course. Another interesting factoid, this is another report that just came out a few weeks ago, and it comes out every 2 years. So it's another kind of interesting signal. And what this is showing is changes in the global nuclear fuel inventories over the last 2 years. And these are in millions of pounds. This is not the pounds they own. This is the delta or the change in pounds held of U3O8 equivalent. What's interesting to us is basically all the inventory levels are essentially flat, down slightly with the exception of one, and that's China. So China has added 86 million pounds of inventory in 2 years, while the rest of the world has largely been sitting on their current levels, meaning they're not really building up inventories to replace what they're using. They're just kind of holding what they have. It's very interesting to us. It does, I think, reinforce the fact that geopolitical risks are heightened, and with all of these restarts and uprates, we think there's going to be more organic demand for uranium as more plants come back online and get scaled up. So just to build on the earlier graph, this is a little bit more granular, and this model comes courtesy of Cantor Fitzgerald. This is their supply-demand model. As you can see, the annual expected uranium demand in the year 2040 from the WNA is 300 million pounds. This year, we might produce about 150 million, and that number is obviously going to go up with restarts and new mines. But based on expected restarts and greenfield projects that they're expected to come online in the next few years, you're still talking about a deficit of 1.3 billion pounds cumulatively between now and 2040. It's enormous. The sector basically needs to figure out how to double production when we've largely been in a state of stagnation for most of the last 13 years since Fukushima. This is a big challenge, and obviously it's a big opportunity. And I'll get into some of the restarts in a minute. So the other thing that's, I think, very important is historical perspective with the price of uranium. And this comes from Bank of America, and I think it's very helpful. So the dark blue line is just simply the nominal price, and you can see the last 2 cycles. But I think more importantly, you have to inflation adjust these numbers, because as we all know, inflation and the cost structure of mining has changed enormously over the last few years in particularly. If you inflation adjust the past 2 market cycles, you get about $170 a pound. That was in the 1970s when we were building out most of the existing capacity. And in the super cycle of the 2000s and in the year 2007, if you simply inflation adjust that by some very basic measures, you get about $200 a pound in the spot market. As I said, we're at $81 today. So we still think that even though the price of uranium's gone from the 20s to the low 80s over the last 3 years, we still feel as though it is an asymmetric trade right now, because there is obviously a lot of upside potential, and it seems as though 80 is a very firm floor based on the last few months. So let's flip over to the trust a little bit. I'll get into that. I think a lot of people are familiar with it. It just crossed its 3-year anniversary in July. We're very proud of its success. Investors have done very well in the vehicle, particularly the ones that supported us in the early stages. The shareholder base has changed enormously, particularly over the last 12 months. We've gone from many boutique shops, family offices, and specialty funds to much broader generalist funds. And it's been amazing to us how diversified the thematic is going into different portfolios. It's going into commodity strategy, natural resources, energy, alternative energy, clean energy, some value funds. It's been really versatile in terms of how people are applying this into their portfolios. So where are we now? We have 65.5 million pounds of uranium. That's about $5.2 billion right now. As I mentioned, we purchased about 2.5 million pounds this year. Last year, we bought 4.5 million pounds. And we obviously would like to buy more. We're back to around NAV right now. As I mentioned today, we raised about 8 and a bit million. Yesterday, we raised a little over 1 million. So we're starting to rebuild our cash position. One rumor I want to squash because it seems to come up time and again, and it's come up more recently. There still seems to be this lingering belief amongst some utilities that somehow all of our material is going to be mobile. I was even told by another bank analyst that was hosting a very large US utility that they weren't worried about the uranium utility because they were just going to get it all from Sprott. This is absolute absurd. I don't know why they continue to latch on to this desperation strategy. They really need to go buy their own uranium. We have not sold a single pound of uranium since the vehicle started. We have not lent out a single pound of uranium, and we've purchased obviously about 47 million pounds. So I wanted to address that because it's an ongoing nuisance that we continue to hear in the market. So just to give you guys some perspective, we started the vehicle, it was about $8 US a share. We peaked out at about 25. You can see the correction we've had since mid January. The good news here is that NAV and market price are touching again. What we find historically is that the discount can persist for a few months, and historically it tightens up, mostly driven on the back of news. And it doesn't often take many positive catalysts to really, get the fund going. So as I said, it feels as though that some of these headwinds are behind us. I think interest rates moving to the easing part of the cycle is going to be very beneficial for a number of commodities. And I think just generally people are continue to be very interested in uranium. When we talk to investors around the world, every week we seem to stumble upon another large institution that reaches out to us and says, we are 2 weeks in or 2 months in or some short period of time into our uranium research. We've never invested in it, or we haven't invested in it for 10 or 12 years, and we want to get back up the curve. That is a very regular occurrence, and we spend a lot of our time and effort on education, trying to, piece together some of the quirks of this market and fill in some of the information gaps. So it's, in many cases, why investors opt to buy the trust is they have a bullish view on the commodity. They don't want to take a lot of equity risk or jurisdictional risk, and they have some proportion of SPUT along with some equities. And sometimes they trade back and forth depending on relative value, but they typically would like to have some exposure to the spot market. And the vehicle obviously is the largest of its kind in the world. So just to sum up, I think there are very strong long-term secular drivers of this market that are not going to go away in the next quarter or two or a year or two. The world has really shifted back to nuclear energy. It is very simple. It's about realities of electrons. You cannot run highly industrialized economies on the back of renewable energy. Where I live in Toronto, Ontario, Canada, 50% of our energy comes from nuclear. As Treva mentioned, we're now building 4 SMRs. I hope we're the first in the world to get them off the ground. And this is just the reality that these power stations, including the ones that were destined to shut down prematurely, plants that have been closed for 2 or 3 or 4 or 5 years, the fact that they're being restarted, I think, really speaks to the growing interest in low carbon energy, the importance of baseload power, and the fact that energy demand is going up for the first time in markets like the United States for 20 odd years. The technology companies are very aggressively focused on the deployment of AI technology, which is very energy intensive in terms of data centers. They are going to utilities and telling them, hey, we need a lot more power in the coming years. And as you can imagine, slow-moving utilities are saying, yeah, no problem, we'll get you that power. That'll be 5 to 8 years. They're taking matters in their own hands. They're signing very large power purchase agreements with the likes of Constellation Energy, with the likes of Brookfield Renewable. They're basically solving their own problem. And what's great about that is the technology companies are obviously incredibly deep-pocketed and innovative, and they do not want to lose this AI race with other countries. So I think this is another catalyst that we clearly would not have identified even a year or two ago. So security of supply risks remain very high. I would say this has been a key theme for 2.5 years. It's impossible to predict what the Russians may do. It's clearly becoming more challenging to get material out of Kazakhstan. The alternative route is much costlier and more expensive, and they've signaled that getting uranium to Western utilities is going to become more difficult going forward. We still think there's a lot of room for this utility contracting cycle to accelerate. Clearly, it hit a bit of an air pocket. But we think ultimately, to borrow the phrase from Cameco, you can delay and defer, but you're going to eventually buy and pay them. So that I think is a perfect summation. I think it's fair to say that for 10 years, utilities became incredibly accustomed to having the ability to buy as much uranium as they wanted under incredibly favorable terms, fixed prices with all kinds of flex options and whatnot. Those days are gone. There's definitely been a resetting, a recalibration of contract terms that are much more favorable to the producers. And also, it's really encouraging to hear from multiple CEOs up and down the food chain that uranium miners are being invited by utilities to participate in these RFPs. That's really great and very important to support a lot of restarts of brownfields. As I mentioned, if you look at uncovered requirements going out for the next decade plus, they're significant. And there's only one way to solve a supply gap, and that's obviously higher prices. The current pricing structure of uranium is incredibly supportive to restart existing mines. When you hear stories about mines that haven't been operating for 15 years coming back online, I think that tells you everything you need to know about the cost curve. The big challenge is obviously building new mines, particularly in higher cost jurisdictions like Canada with very high operating standards, but they are going to be built, and we're very hopeful they will be built. And then finally, I would say, interest in uranium investing has really improved and broadened. There are times where I'll be traveling through continental Europe, and people say, this is a really compelling thesis, but we're not allowed to invest in anything related to nuclear energy. And I say, well, that's absurd. Why? Well, we follow these Morningstar screens, and things like nuclear energy and pesticides and weapons and all get caught in these ESG things. It's absolute absurdity. Governments around the world are obviously shifting policy back to nuclear energy, but there's still this time lag where large institutions need to change internal policies to be able to invest in uranium and the nuclear sector. But I still think that the biggest challenge the industry has in the short term is investability. We talked to lots of large institutions that want to get positioned in the sector. They quickly start looking at the names in the sector and say, oh gosh, we're only able to buy 2 or 3 of these things based on all the liquidity and market cap constraints that we're subject to. And that's a real shame, because obviously those firms have a lot of capital that they could put to work. It's going to take time, but as the sector recapitalizes and grows, those institutions, I think, are going to be increasingly focused on getting positioned. So a lot of the legacy stigma and some of these legacy constraints, I think, are slowly going away. Maybe with that, I'm going to pause and open it up to questions.
Thank you, John. Yeah, brilliant overview. And your point about the bigger generalist funds coming back into the sector is certainly well made. We've certainly seen evidence of that, where that a lot of money coming in at the start of the year, perhaps, and some of it actually withdrawing in that last quarter, which maybe exacerbated some of the downturn. Also extraordinary, actually, to see the level of short interest in some of the equities that are appearing right now. And interested in your take on that. Well, as a market participant who's sort of familiar with the sector very well, what do you think is going on with the level of short interest in the equities at the moment?
Yeah, well, it's a great point, because these uranium stocks are obviously very high beta, and what I find is that there are certain funds out there, whether they're hedge funds or ARB funds or whatever, that love playing high volatility names. It almost doesn't even matter that they're uranium companies. They could be gold stocks for that matter, but they just love playing volatility. And because they are very high beta names to general market movements, they will play these things, they come and they go. Some of these names are obviously not overly liquid, so they can push around the names in the short term. The other thing that's happening, obviously, is some of the ETFs are quite big, and they're getting ever increasingly large. And they are also, I think, having a ripple effect amongst some of the names. So, for example, when ETFs are rebalancing, including our own, whether that happens every quarter or every 6 months, they can be forced buyers or they can be forced sellers of some of these names. Some of these names are added to an index, they're removed from an index. And the way that ETFs basically operate is they're really focused on tracking error. They're not necessarily focused on best execution or price. They really just want to maintain the smallest amount of tracking error to the index. And so you often will see a name really sell off or spike with 10 minutes to go before the market closes. That is very typical activity from index ARBs or ETFs rebalancing. And so what we notice is that sometimes there is a outsized impact on some of the smaller uranium companies because a lot of institutions are opting to buy the ETFs instead of buying individual names because they just want to buy the basket. They got a positive view on the thematic, but they don't want to do the individual company research. They just trade the whole basket. And that also, I think, has a knock-on effect on some of the names from time to time.
Yeah, I mean, the volatility in this sector is extreme. We saw that in our market yesterday with moves of sort of 10 to 20% in the equity names on those headlines coming out of the US around Microsoft and the banking sector supporting nuclear, which, reality is doesn't move the needle much at all in the short term. But clearly sentiment is a big driver of the stock moves. John, I want to just quickly ask you about, you're obviously active in the spot market. The spot market, as you rightly highlight, has shrunk considerably, the level of activity there. Can you talk to us about the liquidity in the spot market? How easy is it to actually source and buy pounds, and where do you source and buy those pounds from?
Sure. So there's always pounds available in the spot market. It's very inconsistent. Some days you might be able to find 3 or 4 or 500,000 pounds, and then some days you might go 2 days without any material being available. So where does the spot market material come from? Well, a lot of it comes from offtake agreements that traders have. Many of the Japanese trading houses have long-standing offtake agreements with the Uzbeks. So that material always seems to come into the market and is looking for a home. Now, one thing I really want to highlight to everybody is that uranium is very different than other commodities in that there's not an active futures market. Now, why does that matter? Well, because if you're a trader and you just got an offtake, you don't have a low-cost way to hedge your long position like you would in gold or silver or copper. So these traders are often very price insensitive when they need to clear material off their balance sheets. And they don't have big balance sheets at times. So you often see a lot of disturbances in the spot market. Some of it is unintentional, some of it is intentional, unfortunately, that can knock the spot price around, which is why it's more volatile. But there's always material available. There historically has been some available material from secondary supply that could have been from other hedge funds that held material in physical form. A lot of that material is gone. It's actually been sold to us over the last 3 years, and many of them have switched from owning physical to owning SPUT. And the reason's pretty simple. If you think about today, I can't remember the number at the top of my head, but if you think about how many tens of millions of dollars traded in SPUT today, it is significantly more liquid than the spot market. And so it theoretically is a more effective way for hedge funds to get exposure. The other thing I would say is that in the last few months, we've had a lot of generalist investors come into the space who missed the first part of the rally. And, because they missed the first part of the rally, their focus was, I want to buy the units as cheaply as possible, meaning, hey, if you're at a 10% discount on NAV, that's great. I'm building a position. If I could buy uranium at an implied price of $72, I'll do that all day. And so we had a lot of institutions kind of nibbling away very quietly, building up positions while the fund was at a double-digit percentage discount. It's obviously paid off for them because we're back, to NAV now. But I would say that, in the early days, we had a lot of momentum. That's the label we've given them as a segment, momentum-oriented investors who were very focused on buying the trust at a premium to NAV so that their cash would go in the fund. Now, I think as more generalist investors who are coming later in the middle innings of the rally, they're more focused on nibbling away at the fund when it's at a discount. And that's important because it helps keep the fund tight to its NAV.
Yeah, as you say, you're back at NAV now, and good to hear that you've raised some capital in the last couple of days. I presume that money almost goes immediately back into the market. Buying uranium, you're obviously not there to be a cash fund. So yeah, is it almost an instantaneous process, raising capital and then purchasing material?
Yeah, typically it is. Now we've raised about 10 million in 2 days, so it's right now sitting in cash, and I think our cash position's around 28 million. We always hold this buffer of cash because I don't want to sell uranium, which we have been able to do, avoid doing since day one. So, we'll start to think about that cash position and whether we want to start deploying. It's interesting because, the typical trading lot of uranium is 100,000 pounds of that. That's now $8.1 million versus when we started this is 3 million. So it's interesting the spot market is starting to trade in more 50,000 pound lots now as the prices has gone up so much. So yeah, we'll be looking at the coming days, and hopefully we can continue to build up our cash position and start buying again.
Yeah, great. John, look, that's been super insightful as always. I really appreciate your overview of the overall market and some descriptions of the SPUT vehicle and how you work. And congratulations to you and the team there on what has been a visionary process. Understanding that this was going to happen and putting this vehicle together 3-4 years ago. Well done on all that, and look forward to seeing you back in the market purchasing uranium as your price is above NAV. So, thank you.
Thanks very much for having me.
Terrific. Okay. Our next speaker, we're now into the company speakers. So you've heard the overviews from Trevor and from